So the format for this presentation is that obviously I wanted each of our panelists to open it with sort of a presentation to share some of the views, and each of them were given specific topics in order not for us to overlap, and then also in order for you to get the best out of the panel. And the nature of this is obviously Harry has given us the overview of the 2022 market, but then I did some listening in the corridors. I talked to some people yesterday, and two words kept coming up: price and China. So I was very happy when the Cobalt Institute obviously brought some of the best in these areas to talk about where prices will be tomorrow, the day after, and who knows, even the next year. So without saying much, I think I'm going to invite you, Robert, to please talk about prices and its outlook, if you don't mind. And you can use the podium.
Thank you very much for the introduction and for having me here to speak today. So my name is Robert Searle from Fastmarkets as part of the analytics team. I focus mainly on the Cobalt side as part of our long-term forecast and also the weekly tracker, short-term price forecasting. Today I'm going to talk to you a little bit about the Cobalt pricing. I am going to touch on a few of the same topics as Harry, given what happened in the last year, but then we're going to go on to some of the outlook and some of the more macroeconomic or structural impacts which we see having an impact on the Cobalt market over our forecast period out to 2030 and beyond. So if we look now starting in 2021, so I've taken the metal price on the and the standard in China as well as the sulfur indices on that top chart. Starting from 2021, we saw standard grade begin around $15.3 per pound. And our vision going through 2021 there was of a fairly strong demand side. We saw a strong recovery coming out of 2020 post-pandemic, and there was growth in metal and salt demand. Harry's touched on the record year that we saw in consumer electronics and portables, driving cobalt tetroxide from that increased working and education at home. We've also seen that recovery in superalloy demand, which took such a hit in 2020 as air travel and passenger travel was shuttered by the pandemic. So as we see prices there on a demand side, we had a fairly bullish outlook going through 2021. The future demand was looking good. There was restocking across the value chain, driving the prices higher. But really what we had was also earlier an upstream driving problem. Tightening upstream conditions on hydroxide supply, beginning with the COVID-related issues, logistics disruptions on high-priced and limited container volumes, followed by border controls between the DRC and South Africa, lockdowns restricting the movement of material from the DRC, and then obviously as we see payables remaining around 90% into 2022 as we had the flooding issues in South Africa, which pushed up and sustained these payables around 90%, reducing the units of intermediates flowing into China for refining from the DRC. And this, alongside with demand, supported these metal and salt prices. Now, April, May, what do we see? Well, everything starts to plummet. Upstream, we have sort of the logistics disruptions that we talked about starting to ease, and we have this lengthening hydroxide flow, as well as growing MHP supply from Indonesia, reducing the cost pressure downstream. At the same time, lockdowns in China starts to affect the consumer electronics market, starts to impact the CAM producers. We start to see CAM producers choosing to destock into these weakening prices rather than buying more material, given the stocks they built up in preparation for the year. And you start to see, as Chinese prices fall slightly ahead of the standard grade there, we get a premium opening up. And we see more of this Chinese metal moving into the seaborne market, which then starts to lengthen supply and bring down that standard grade. These recessionary fears essentially led to a lower forecast EV growth, as we saw LFP growing in market share in China in particular and globally in 2022. There was some perceived alloy tightness, as we see a small bump in around August there. And there was talk of potential strategic stockpiling, which did temporarily halt the slide. But the record production growth we saw in 2022 did outstrip the demand. And we have standard grade peaking at around 40 in April, finishing the year below $20 per pound. So now a little deep dive and focus on our expectations coming into the first quarter of 2023 and what we've seen. Well, so far, we've seen that prices have continued to trend downwards in the first quarter. We see on the chart on the right there the discount of China metal against standard grade, with standard grade coming down from a higher level, and that premium or discount has been eroded to almost price parity. There are expectations or hopes that potentially in Q1 we may have reached some form of bottom. We saw this on potentially some minor restocking or trader activity looking to judge the market, and this did tighten the China metal market. But aided by the removal of the import tariff on the 1st of January, as that China premium opened up there above standard grade, we actually saw an increased amount of imports into the Chinese market from the seaborne market, halting that rally. On the sulfate pricing, the chart below showing from mid-year of 2022, the cobalt metal content and that discount against the China metal price. We've continued to see this growing discount against metal values for the sulfate prices. What we've seen in the second half of last year was significant destocking in Q4, particularly in 2022, and that a discount widening in December ahead of the removing of subsidies in China, as well as in certain EU countries. In Q1, we've seen that this has actually continued. We expected there could be some need for restocking, but so far, CAM producers have decided to kind of track the bearish lithium prices, and we have CAM operating rates at around 40 to 60% averaging through the quarter. This similar discount was seen on the sulfate side in early 2019, when EV subsidies were actually reduced in late 2018 for the first time, and demand was not as strong as was expected. OEMs have been seen to be reducing sticker prices leading up to the end of last year and through Q1, which has kind of ignited a sort of price war in the new energy vehicle world, as well as having to compete with internal combustion vehicles who have been cutting sticker prices in China. And so the ending of the zero-COVID policy in China has yet to have the desired effect on the downstream demand that we thought we would see heading into 2023. And the uncertain macroeconomic conditions continue to limit the upside on demand in the first 4 months of the year. But really, a lot of the pressure, and almost most of the pressure now that has been the conversation of this conference, is coming from the upstream. Hydroxide prices are extremely low, payables have continued to fall. We now see hydroxide prices below $8 per pound, getting quite close to the cost of production. And so those significant falls, where we say now, is payables at around a 51 to 54%. Standard grade is sitting below $15 per pound, and we have sulfate down at 35,000 yuan per ton. So on to our outlook. Well, I think the overall message here, going through to the end of the year and into 2024, is we do expect a recovery in these key end-use sectors, but it's going to be amid a backdrop of capacity additions, which began in 2022 and we expect through into 2023. On battery-grade metal, we're expecting a recovery in CAM purchasing and operating rates, as well as potentially being supported by further stockpiling later on in the year, which could support metal prices. Alloy grade is continuing to see resurgent demand. There are long order books from the aerospace sector, and we expect this to continue to return to around its pre-pandemic level in the mid-decade. Consumer spending is expected to pick up in the second half of this year and into 2024, and with that we do expect some revival in the consumer electronics, particularly after a couple of lean years and needs for new generation of 5G smartphones or updating electronic equipment. At Fastmarkets, our focus mainly is on the EV market, and so when we look here on the sulfate, on the short term we are expecting this recovery in the sulfate price on NMC CAM ramping back up. We started to see some signs that demand may be returning, with Tesla raising some sticker prices in North America and China. And further growth in the US is expected as a result of the Inflation Reduction Act and the impact in the midterm. Of course, LFP is a major talking point, and we're still expecting it to hold market share in China, as well as spreading into European and North American markets, as we see a greater mix of chemistries across the EV space. But the Western preference for NMC is expected to continue to support sulfate, despite lower loadings, which Harry touched on, in these chemistries going forward. The offtakes as well, which are highlighted in the investment upstream, is evidence that Cobalt is still needed. Our view is that the sheer unit sales in the EV market will continue to support Cobalt despite some of the headwinds we've been seeing. For 2022, we believe we saw around 6.2 million sales of Cobalt-containing electric vehicles globally, and this sheer growth, which could reach up to 19.5 by 2030, is expected to drive Cobalt and sulfate demand. There will also be a need for restocking in the short term, which will drive further support, hopefully in the second half of this year. On hydroxide, unfortunately, the fundamentals are not as positive. In the near term, of course, the return of the tanker units, major capacity additions in the DRC, as well as the emerging MHP units, will continue to weigh on prices. There is discussion about how much of the tanker units have been actually priced in already, and there does remain logistics issues in moving material from the DRC to China for refining or elsewhere. The low pricing as well is expected to lead to some cutback in artisanal volumes, and some producers are also expected to limit production given where hydroxide prices are. But overall, our view of the market is that we expect to see a surplus this year and in the short term, with the market overall tightening from around 2026 onwards as production adjusts and demand grows. And so finally, I think these can sort of just be points we could talk on the Q&A, but some of our longer-term structural and macroeconomic impacts which we see impacting the cobalt market going forward. So obviously, short-term headwinds in cobalt, but we are still bullish on the long term. The IMF is forecasting one of its weakest outlooks in 30 years, and the macroeconomic outlook continues to weigh on cobalt demand. This is combined with that inflationary pressure and the high interest rates we see. The EV market has previously fared well in difficult economic times, but this theory will be tested further. Interest rates continue to impact the cobalt market in threefold, with the funding of projects and mines, the cost of financing for trading houses in a low-price environment, as well as the cost of financing and loans for consumers looking to transition to EVs. The IRA and Critical Raw Materials Act and other legislation will continue to spur demand as well as investment in localizing supply chains, and it will be interesting to see how this develops going forward and what sort of premiums are attached to material sourced and produced in these regions, as well as the growth of recycling and the reduced need for mined extraction. ESG concerns, of course, will continue to play a part in the cobalt market and could determine whether premiums open up or what pricing is attached for material of certain levels or low environmental cost. On the loadings, these are expected to fall, but we still expect NMC 622 and 811 to be dominant chemistries in the EV market, despite the future growth of LMFP, high manganese, or high nickel. The diversification of supply in the cobalt market is hopefully expected to lead to less volatility, requiring one supply source to be such as the DRC. We may not see the bottlenecks that we did in 2022. And of course, finally, a key one, the growth in demand and supply of the copper and nickel markets as part of the energy transition. Thank you very much.
So much. A very brilliant presentation, and I do have quite a couple of questions that I'll come back to you. But then, of course, obviously, it's important that to really get a full picture of the market, we understand the biggest producer and the biggest consumer of cobalt. That is why we have my panelists, Yanchen, to talk about China and its outlook. Please, a round of applause as he makes it to the stage.
First, thank you for the invitation from the Cobalt Institute. I'm Yanchen from the Shanghai Metals Market. Today, I would like to talk about the Chinese market, definitely, and also about the raw materials pricing. So let's move to the Chinese market. And from the left-hand chart, you can see, LFP is gaining more market share in Chinese market. So in the Q1 2023 this year, actually the 68% of battery actually is LFP. And NCM battery only, about 32% of in the market. So we don't believe the LFP will gain more market share in the EV market because the Chinese automaker also moved to the high-end EV in the futures. So definitely NCM battery has their advantage in that term. But we believe, LFP still will dominate the power storage market in China. So in terms of from the right-hand chart, you can see the ternary cathode materials output in 2023 actually achieved about 655,000 tons per year. And so it's increased about 55% year-on-year base. And also you can see NCM 811 actually output is achieved about 282,000 tons. compared to 2021, actually increased by 91%. It's significantly increased in terms of that. And so that definitely from the bottom chart, you can see NCM 811, actually proportion of the ternary cathode materials output is from the about 20% in January 2021, increased about to 55% by the end of March 2023. So that means, the high nickel content battery is gaining more market share in Chinese market, and that definitely need less cobalt. And from our research, we can find that, in terms of in Q1 2023, actually China produced about 135,000 tons ternary cathode materials. Actually, it's decreased a little bit, about 3.5% year-on-year base. But when we do the research about cobalt demand from the cathode materials, actually decreased 15%. So that is mainly driven by the less cobalt in the battery. So definitely there are the two factors, LFP and high nickel content battery are the driver of less nickel demand. But also there are the two other factors in the market. One is, less demand in the consumable electronics, like a mobile phone and the laptop. And the other factor actually is due to the sharp decrease in the price, because all the producers or the consumers now doing destocking rather than restocking. So that is, they want to reduce their stock on hand, so to reduce the risk. So there's a total 4 factors affect the cobalt demand currently. Let's move to the demand side, and the supply side actually. And from the right-hand chart, you can see China actually import lots of raw materials, mainly it's a cobalt intermediate product, and also some cobalt concentrate. And in Q1 2023, actually China import about cobalt raw materials increase about 2.6%. Even the demand is decreasing, but the import is still increasing. So we can see the majority cobalt raw materials from the DRC, and almost 100% cobalt concentrate from DRC, over 98% cobalt intermediate product from DRC as well. Because of the huge import and at the same time the weak demand, we can see the cobalt intermediate product import price actually sharply decreasing from the last year, second half of last year. Of course, Indonesia is a major player now in terms of cobalt supply in China. And as you know, Indonesia started to produce MHP in 2021, only started that. But in 2022, they already achieved the largest MHP suppliers for the Chinese market. In the Q1 2023, China imported about 320,000 tons MHP, of which 53% of the MHP from Indonesia. So actually, I just visited Indonesia last month. So currently, there are the 4 players producer MHP in Indonesia. But by the end of this year, we believe the other 2 players will come on stream. So total will be 6. And in terms of cobalt or sulfide market, we can see, from the last quarter in 2022, actually the market becomes surplus. And in the Q1 2023, due to the weak demand and more supply, so the cobalt sulfide become even oversupply in Chinese market. And that leads to the other issue is we can see at the bottom chart on right hand, you can see the cobalt or refined cobalt price actually, the ratio of the refined cobalt price against the cobalt sulfide price is increasing. So that means the gap become bigger and bigger. And that will be result in the other issue for the cobalt sulfide producers. So we can see from this chart, if cobalt sulfide producers still using, refined cobalt price to pricing their raw materials, for example, the MHP or the cobalt or intermediate product or cobalt concentrate, and that means their operating cost is quite high. In most of the 2022, actually they are lost money. because they sell their final product, cobalt sulfate, to the Chinese market at a lower price, but their raw materials based on the refined cobalt price, which is quite high. So currently, in recent months, actually, the profit rate for the cobalt sulfide producers actually start decreasing again, and it's we estimate about -5. So that is the reality for the industry currently. So the industry need a reasonable pricing mechanism to fix that issue. That can secure the industry, more healthy, more stable. So that's why SMM, issued a new pricing mechanism for cobalt intermediate raw materials, and use that new cobalt sulfide price-based pricing mechanism. We can price cobalt intermediate, MHP, and even the scrap. So as you know, the scrap is becoming more and more important in the cobalt supply and also other nickel supply as well. So using the new pricing mechanism, we can definitely to give the market the reasonable price for the producer, for the suppliers as well. So that is, if you want to have more details about the pricing mechanism, please contact with me, and we can have the chat after the conference. Yeah. And definitely, we are very positive about the cobalt sulfide and the cobalt demand in the future. And we can see the refined cobalt production on the left-hand chart. It's increased a little bit in recent year, but a significant increase is cobalt sulfide demand, the production number in China, actually. And in the long run, we believe the cobalt sulfide, will be the dominant market, dominate the cobalt demand in the future, especially from the lithium battery market. And that is in line with the other institute. And so that means, the market really need the new pricing mechanism for the raw materials that can guarantee, from the cobalt sulfide producers to the battery producer, even to the OEMs, they can have the stable price, they can hedge their risk, and to give the more stable production operation situation. So, yeah, this is today my presentation. Thank you very much. This is my contact details. If you have any question, welcome to contact with me. Thank you.
Thank you so much. That was a very, very enlightening presentation. I think he deserves another round of applause, please. Yes. So I think I'll probably start with you, Robert. And it's important we always open the conversation with prices, because I'm pretty sure there are a few of us here who probably eat prices for breakfast even before we start our day. How many of us checked the prices of cobalt on the LME this morning?
Just you, Kwasi.
Was I the only one? Well, don't worry, I'll tell you, because I have a Bloomberg terminal. $34,483 per ton. And guess where it was last year? It's around this time. Anyone? Wild guess? 80,000. All of us were happy somewhere around this time last year. So my question to you, Robert, $80,000 to $34,483. Why is it going down?
I would say there's kind of been a major mismatch in the expectations and the realization of 2022. I think the heading into the first quarter, obviously we touched upon how there was kind of a fairly bullish outlook for demand, as well as expectations on, we need to restock on this side, we need some capacity additions. And that material wasn't really getting to the market efficiently, and it kind of, I assume, made people worry a bit more. People built up more stocks on the midstream and the downstream because they're struggling to get those intermediate units. And then all of a sudden, things kind of clear up. You have the impact, obviously, of the Ukraine war, pushing up energy costs and kind of throwing the macroeconomic recovery post-COVID into sort of not free fall, but a stumbling block, let's say. And all of a sudden, we start to see these, the expectations in consumer electronics and portables, the expectations in EVs start to kind of soften at a time when all of a sudden material is more readily available, much cheaper than it has been. And so, yeah, the destocking has been a major factor through the second half of last year. No one was wanting to be caught with material on their hands in this weakening price environment. The subsidies heading into the ending of the subsidies heading into 2023 is obviously people are still trying to figure out. I mean, consumer spending is low, so EVs are pretty high up on that list of necessary items to be going out and purchasing. And so really, yeah, it's been in just a perfect storm of mismatched supply and demand with this aggressive oversupply coming in from what was probably a very tight or deficit market in 2021 and demand just not being there when it arrived.
Yeah. And I think you talked about destocking and restocking. When do you think restocking will start? I mean, sorry if I'm putting you on the spot.
No. I've been trying to think it's been starting for the last couple of months. I think we thought that after the Lunar New Year in China, there might be a need for it, given 6 months of running down material rather than buying new. That didn't really happen, maybe a minor bit, but I mean, that was a small rally which then got eaten. Q2, obviously, I think there was kind of this idea of maybe a seasonal restocking, but that could be more for the consumer electronics sector, which is still, on the precipice of a return. I think the hope will be that we're going to have to see some restocking. I think a lot is maybe on the CAM side is going to be when lithium prices. They're going to really, that was a major driver in Q1 of sort of the rest of the nickel or the cobalt side destocking. I think in China we are starting to see more support on the lithium side, although there is, there's talk that maybe stocks are fairly high on that commodity at the moment. But once I think the market gets a signal, firstly that the downstream demand is returning, and firstly that maybe the lithium price is returning, then there's going to kind of be, that real demand element as well as that restocking boost to prices.
So, ladies and gentlemen, as soon as you see these signals, that means restock has started. So there's something I wanted to sort of highlight, and I think, Yanchen, you talked about the fact that you're quite bullish in the NCM chemistry in China, increasing its market share over the long term. And I think, Harry, I must have heard you say that LFP's prospects in China, there's still headroom for LFP to grow in China. Was that right? Because I don't know if there was conflicting opinion as to what the ultimate battery chemistry in China would be, and I'm happy to start a debate and be the judge.
I think we had a similar view. I didn't see anything on Yanchen's slides that I was particularly shocked by. His China numbers are a lot better than mine. But, I think the view is fairly similar. Is that LFP has been very strong in China, and there's been a significant build out of LFP and even high nickel NCM capacity, but it's very much, LFP is very much still in China.
Yes, I agree with that. Actually, LFP battery in China is quite popular. It's because it's cheaper, definitely, and it can meet some demand from low-end automakers, and it's good things. And also, the LFP China will produce more LFP, but not only for the EV market. It's for the power storage, because they have a long-time recharging life. And also, it's more safety than lithium battery, the other lithium battery. So that is the key things. And in terms of auto industry, we believe because Chinese automaker will move to the high-end product in the future, so that they need new NCM battery rather than LFP. Yeah, especially China will want to export more EV to the rest of the world. In the first quarter of this year, China already exported about 248,000 units EV to the rest of the world. So that is significant increase, actually. And so definitely they need more NCM battery in the future as well. Yeah.
Yeah, that's a very important point you raised there. And then, so just a quick one, ladies and gentlemen. Ultimately, in the next couple of minutes, I would open the floor for you to ask questions. There's a microphone that would come to you if you put up your hand, and it's just your name and your organization, and you can ask your question. So please, as we have our conversation upstage, if there's anything that you want us to probe further, just note it down, and ultimately, when I open the floor, I'll take your questions as well. And I think that was an interesting slide, when you were presenting, and Robert, unfortunately, I would have to ask you for clarification on that, because there was one where you talked about, I think the cobalt sulfate prices is irrational. Mm-hmm. And do you agree? Do you think the cobalt sulfate prices are irrational, Robert?
I'm not sure if I'd say irrational. I think as we go forward, there's going to have to be a looking into how we're actually pricing this. I think, as you touched on, it's going to become the major driver of cobalt demand. It's growing in share on the lithium-ion battery side. And so it doesn't really make sense necessarily for it to be coming off a much smaller portion on the metal side. I think in terms of whether it's going to completely decouple or move away from it, I'm not sure. I don't think necessarily that's the case. Obviously, with a lot of MHP arriving in China, and that's kind of been favored for sort of that NMC production, whilst our kind of projections, and they're slightly lower for total cobalt demand by 2030 or 2033 is the end of our forecast, around 50%. I think our view of the Indonesian MHP supply is around 20 to 25 potentially. So there's still going to be a need there and a competition for intermediates from the DRC for hydroxide, and obviously the changing market dynamics of both the metal and the sulfate side is going to kind of affect the other one. There's still the option, particularly in China, where you can refine that hydroxide into the sulfate or the metal, so they're still going to be competing really for feedstock. So I think it's going to be more potentially taking the lead over the metal price as it becomes a larger sector of the cobalt market, but potentially not irrational or completely decoupled.
And yeah, of course, I wanted to come to you to clarify that, because you talked about the cure being a much more transparent pricing on intermediaries and scrap. I don't know if you want to sort of add something to that.
I think currently we can find a trend. Refined cobalt and cobalt sulfide, they have their own market dynamic, you know, and so because like a battery producer, they don't use cobalt anymore. They just directly use the cobalt intermediate product or the cobalt sulfide, right? And for the long-term stable operation, they need a new pricing mechanism for their raw materials. That means they can hedge their risk.
Yeah.
But if they still rely on the refined cobalt price, you know, it's not good for them. This is the market requirement, not our push them. And from our experience and also the market view, we can see already this trend is happening now. I think if your clients or your customer want to use SM price in their contract, you will not be surprised anymore. Yeah.
That's great. And I think you talked about something very important that I want us to sort of probe further. Harry, I'm going to come to you on this. It's really about scrap and ultimately the recycling market. And I think either this week or last week, Glencore, should be this week, made a major announcement about yesterday. Yeah. Oh, wow. Jeez, I lost count of days. And Glencore made an important announcement about building one of the largest recycling facility in Europe. And in all this, in what we've talked about, supply, demand, where do you think recycling's role is?
So we produce recycling forecasts across all of the raw materials that we cover at Benchmark, because it's a critical part of thinking about the supply side going forwards. I think it's important to remember that at the moment, most scrap and battery scrap that's available is process scrap. It's not end-of-life material yet. If you kind of assume that an average EV will last 10, 15 years and EV sales only really started to kick off in 2020, 2021, we're still 10 years away from a big wave of end-of-life material, and that's before thinking about second life. But our kind of view is that around kind of 4 or 5% of cobalt supply was coming from secondary sources last year, and in kind of the 10-year view, that will kind of rise to maybe around 15, 20, 30%. But I don't have the exact numbers to hand, but it's growing quickly. But really, that wave of material won't happen until the 2030s.
And Robert, on the recycling point, so at that inflection point where we hit 20% coming from recycling, how does that really change the price dynamics?
I think it was just going to start to limit the requirements on the mine side and the extraction side. But I think the difficulty, of course, with cobalt is that it being predominantly a byproduct with only some minor primary mines, nickel extraction, cobalt, and copper extraction is still going to mean that you're still going to be pulling this stuff out of the ground. I think maybe on the copper side, it's slightly easier to leave it in tailings. But there's still going to be the demand dynamics of that side is definitely still going to drive capacity additions and supply addition on the cobalt side. So I think the really interesting part for us is both the ability for places like North America or places like Europe, which at the moment don't have a large mine footprint, are able to start to build up that as part of their localized supply chain. And I think also when you feed into it the idea of being able to take material that you can prove, how transparently it's been extracted and refined, how it's been transported, things like the battery passport, and then bring that into more of a circular or closed loop circuit, certainly at least for 15 or 20% of the market, is still it gives consumers confidence, and it's a very interesting way in which the cobalt industry can continue to develop towards its kind of ESG goals.
Okay, that's important. No, thanks. And I'm happy you highlighted ESG, and I'll come to that later. But I want to come back to China, and so really, we just went straight into cobalt. But I want us to take a step back and really put a microscope on China's economy. What is the outlook? Because in the end, like everything comes down to the economy. And what is the outlook on China's economy this year?
As you know, the Chinese government set up the 5% GDP growth target this year, and which I believe is achievable. And what I believe is the service industry will contribute more to the GDP growth this year, because last year the COVID policy. And in the Q1 of this year, we already see 4.5% GDP growth. And we already see service industry contribute lots of growth in that area in Q1. And that means the service industry growth can't bring more metal demand, right? And so that is one thing maybe negative for metal demand in China. The second thing is for the cobalt in specific, and as I mentioned, there are several factors affect the cobalt demand. But we're still positive for EV output in China, and in the Q1 we see 27% year-on-year growth in terms of EV production number, and so that is still very positive. And so that is the positive side sector. And in the other industry, we believe the Chinese government will heavily invest in infrastructure, like power generation, power transmission, and that will need some metals in terms of cobalt, copper, and aluminum, this kind of all the commodities. So yeah, but the negative side is the property market in China still quite weak. And as you know, so that is a long-term story. Yeah. And so they will remain weak, I believe. And so, yeah, I think it's because currently lots of uncertainty in the global economy, and the Chinese government are very cautious to do a lot of stimulus policy. They want to keep some measure in hand in case they needed that. Yep. Yeah.
Well, and I think this is the most positive outlook I've had on China this year. So thanks for bringing my spirits back up. So I think I'll pause here and just take 2 questions from the audience, and I'll get back to my question. So any question at this point, please? If not, I can just keep going on and on and on. There's a microphone behind. Yes, this. So just your name and your organization.
Thank you. Yeah, hi. So my name's Patrick Lane. I work in procurement at Jaguar Land Rover. Thanks for the insights this morning, really, really interesting. My question is just relating to the increase in projects globally, coupled with the LFP capacity and sort of growth in China. What's your view on the viability of sustainability premiums for non-DRC, non-Indonesian material in the future? Thank you.
So anyone want to take that, the viability or sustainability of non-DRC premium?
Was the question specifically about price premium? Yeah, I was waiting for a question on that, so thank you.
Did you guys plan this?
No, it's such a difficult topic to kind of give a direct answer on, so apologies in advance for that. Our view at Benchmark is that there will not be a kind of a separate green premium, as the way we see it at the moment on prices. But that doesn't go away from the fact that perhaps you may have more leverage when you come to sell material into the market. It's quite subtle, and it might sound like the same thing. But yeah, our view is that there at the moment there isn't any basis for kind of a a significant green premium, ESG premium, but it's developing all the time, and it's something that we talk about a lot, and that's the same for kind of IRA premium or CRMA premium. It's a similar kind of discussion, and certainly there's people in this room, I'm sure, thinking, well, if I want to become more sustainable and hit ESG targets, then that's a cost, and who wears that cost? Right. And I'll leave it at that.
I don't know if you want to add something. No?
Yeah, I think the way we're looking at it is a sort of consumers and OEMs are already sort of making this decision themselves a little bit on what material they're willing to take and what material they believe their consumers are willing to take. I do think that we've seen kind of more offtakes on projects which aren't necessarily that far along in places like Canada and Australia. And that's kind of the backing of, a lot of the marketing around these juniors, and a lot of the driver is look at our sort of ESG standards compared to the incumbents, and it's sort of a real sort of funding driving point for them. So I think in terms of maybe there is still some concern that it might not be regulated completely, but it might be that the consumer preference is going to be such that it's kind of like a self-sanctioning mode, where some of this material that doesn't quite meet the grade for a certain market, and I think it will be different by market, is going to struggle to be accepted.
I think, just to add to that, I think that's a really good point about kind of bifurcation by market. If you look at some of the battery producers, and I looked at this for lithium, so it's slightly different than for cobalt, but if you look at what LG Energy Solutions have done in the lithium space in the last 12, 18 months, and you look at the individual projects they're kind of expressing interest in and making deals in, they've all got kind of fairly good ESG credentials. So that's kind of maybe not an ESG premium, but it certainly sets you apart from the pack.
Yeah, and just to add, I also by the way, I'm an analyst as well. I forgot to introduce myself. Yeah, I did a similar analysis on Ford over the last 18 months, all their offtake, and it's similar. It's driving to the point where, like, there is not a standard market preference, which is in the public, but increasingly on a bilateral basis, we're seeing companies shift to areas where they feel the ESG credentials are quite high, and there are obvious reasons for that. So, yep. Any questions? Yes, please. A microphone on the side.
Robin Stoney from Glencore. I'm an environment scientist, so I'm pretty interested in the ESG side of things, and I think that there may actually be a benefit in a slowed pace of development, particularly in places like Indonesia. And the key things that I'm concerned about are things that don't rate as indicators, like that if the pace of development is so fast that there's not the ability to understand the environment that you're working in, and there's not the ability to conduct baseline studies, do those kind of important, detailed, deep dives on environmental matters. And then after that, you can subsequently design for minimal impact once you understand. This also takes time and investment resources and effort. And my concern is around the pace of development in Indonesia and potential that actually the impact isn't being well understood before it's already happening and can't be minimised. Is there any way to, I guess, encourage the Indonesian market to take the time to grow steadily instead of, racing to the market with as much product as possible?
Thank you so much.
I can say something about that, actually.
Please.
I just visited Indonesia last month, as I said, and I talked with local association and the local producers as well. And so from their view, actually, Indonesia and even the DRC as well, they are developing countries. They need developing their economy, and that is the top priority for them. And I think I don't mean the ESG is not important. They want to do more ESG, more progress in that period, that area. But they need time. Definitely, they need time. And so after more development, more profit from their resource, I think they definitely move to the high standard ESG. If you ask them to do the similar ESG standard as the West countries or developed countries, it's kind of unfair for them. Also, they can't achieve that. In reality, they can't achieve that very soon. So that is the reality. Yeah.
Okay. But I think you're right. I think the standards just aren't quite the same at the moment, and I think the companies operating in Indonesia probably, the ESG is not the top priority. I think that's clear. But the Indonesian government have come out in the last few months and said that this is high on their agenda, and they are expecting going forwards that companies will follow global best practice when it comes to ESG. Whether that happens and how quickly that happens is a different story. I think an important part of Indonesia as well is the more Western OEM involvement that we get in Indonesia will lift ESG credentials across the space, because at the moment, very few of the units are going to be compliant from an ESG angle for any of the OEMs. And there's only really one project that's got solely Western investors in Indonesia at the moment. Or the rest of them are Indonesian and Chinese investors. So I think the more global OEMs are involved in Indonesia, that's definitely a good thing.
Yeah, and you want to add something?
No, I think just to add on that, I think the Western OEMs part is a very interesting angle. I think there's already been some pressure to clean up sort of like deep water tailings deposits, but obviously there's a lot of work still to be done. But you would expect that once more of that material is finding its way not just into the Chinese market for refining, but also to sort of Western countries, then there will be more emphasis on it. But yeah, it does seem at the moment the Indonesian government's priority is firstly to get this off the ground and then to develop across the EV supply chain. I think it's kind of from then the investment from the Western world and consumers to sort of drive through that need for that development to be adhering to certain standards.
Okay, thank you. But also, just a quick one. I'm going to swim against the tide and also add that, so we were also very interested in the fact that over the last 2 years, Indonesia has rapidly expanded supply, and why other developed countries have been quite slow, relatively slow over the last few years. And what we realize is that in most cases, when you look at developed economies, the delay is not because they want to be ESG compliant. So the fact that we are not seeing rapid project development in America and Europe or other parts of the world is not because they are probably more ESG compliant. It's just because of bureaucracy in some instances, poor geology, or whatever reason it is. So when we sort of started digging deep in the data, we realized, and this is a very interesting live case. In one country in Europe, the last time a mine project was approved was about 20, 30 years ago. All the expertise that approved this project are on pension at the moment. And as such, nobody in the department wanted to sort of put their hands up and say, yes, I'm the one who approved this project. And as such, the permit sat on the desk for 2 years. So when you look at it from the high level, it would probably feel that these guys are scrutinizing projects, they are doing impact assessment, they are doing great on ESG. But the simple fact is they don't have the technical expertise to approve project. So I just wanted to highlight that. And earlier in the year, I gave a talk out in Durban that if you look at most of the developed countries, even if you look at the Joe Biden administration, the first 100 days, the early executive orders was to train the US mining policymakers to understand the process. And my theory was that there's a lot most developed countries can learn from developing countries. Over the last 10 years, most of new projects have come from emerging economies. And in terms of expertise and managing policies for approval of projects, they've probably experienced the best teacher. So there's a lot of cross-pollination that could occur. But the key point I wanted to highlight is that the fact that we are not seeing rapid projects come online elsewhere doesn't mean they are scrutinizing projects any better than elsewhere. And by this, I put off this hat and put back my moderator hat and get back to you, my panel. So I have a question. I just wanted us to shift a little bit from supply, from pricing. Let's talk about trade. So yesterday I caught up with a few people in the trading community just to get a sense of what are some of the important topics they want us to highlight. And I think one word that kept coming up, liquidity, liquidity, liquidity. And at some point I got confused because we were drinking, I don't know if they're referring to the liquid we are drinking or there's something else, liquidity. It turns out it means money. And one of the biggest challenges in the cobalt market in terms of trading comes down to liquidity and the fact that the market is not liquid. How do you think we can resolve that, Robert?
I mean, having talked with our pricing team and the kind of price development side when I was preparing for this panel, he was adamant that I refute that claim slightly for cobalt liquidity compared to some other markets. I think lithium liquidity is a lot lower. But I agree. I think we see maybe like 10 to 15% of a spot market with the rest on long-term contracts. And the way in which our pricing discovery team works, and I'm sure it's the same at Benchmark and SMM, is really getting not just offers but bids, indications from both sides across the value chain. I think we're really looking at as 10 to 20, as many pricing points as we can get to really pull together what we think is a fair assessment. Of course, in a time when there's not as many offers going through or there is fairly low buying, as we see at the moment, this kind of potentially leads to a wider range or slightly more uncertainty. I agree that I think our team would agree as well on the hydroxide side of it. There is slightly less liquidity, and that can sometimes lead to some disagreements or different views on where the market price really is. But overall, I think the robust methodology which price reporting agencies like ourselves have is to essentially try and cover all the information available across the value chain on the offers, bids, and indications to give what we'd say is that fair balance of the market on that day.
Yeah, well, that's important, that balance, like you rightly mentioned. And that's why, Yanchen, I'm going to come to you. So I also there are a few policy makers in the room, so I also went around listening to them, like what are some of the key things you want us to talk about? And obviously, you've got, in the downstream market, you've got countries or companies operating in various other countries other than China or the US or Europe, right? So Turkey as an example, and all that. Increasingly over the last 6 months, we've seen an aggressive push by some countries like the United States, Inflation Reduction Act, the European Union Critical Raw Materials Act, and without mentioning it, the ambition of all these policies is to try to diversify the supply chain from China. And what sort of the questions I got from our audience was that do these countries, in spite of how ambitious their targets are, do they stand a chance to really diversify from China? How feasible is that dream?
Yes, I think that is the key issue for the industry now, and attract lots of discussion about that. And the first thing is actually whatever US and European Union, and they are like China. They don't have resource in their own countries, in own regions. They need to buy the raw material from third party and other suppliers, definitely from the rest of the world. So that means, I fully understand the United States and the European Union. They're worried about the supply from China. If China dominates all the suppliers in the world. So I fully understand that concern. But from the Chinese company point of view, actually, they already invest in other countries to diversify their supply chain. If you need from Indonesia, you can buy Indonesian raw materials. It's no problem at all. Definitely, they belong to Chinese company. But in terms of, what do you want? You still can buy raw material from other countries. And they would like to supply the raw material to other countries, especially like the United States and European Union. And according to the CIRMA, actually, the regulation and the European Union want to achieve 40% refined metal by the 2030, right, at least. So the reality is that means they will ask the European Union heavily invest in refining capacity. Yeah. But currently in the world, refining capacity already over capacity. That is a situation. Yeah. So if you give more subsidies to the refining capacity, and so that means the world supply side even worse. And so some high-cost producers in the United States or EU, they can survive with the subsidies. It's OK. But how long? That's the problem, right? The huge investment there. So in terms of China, I think the Chinese company just wanted to do business. As you know, there are lots of Chinese suppliers. Actually, they are private-owned. They are not SOEs. So in terms of in order want to supply the rest of the world, they set up the new capacity in the rest of the world. They already do such hard work for that. So if the United States and the European Union want to achieve, get rid of ICE car by the 2030 or 2035, they need lots of raw materials, right? And the local supply is not enough. So definitely, they need to cooperate with some Chinese companies. This I believe. Like Ford and Huayou, they already signed an agreement. And Qingshan and the Volkswagen, they also have an agreement as well. So I think that is the reality.
Okay, thank you. And I think I can open the floor for another set of 2 questions before I continue. So anyone, just put your hands up, your name and your organization, and we're good to go. Any questions? I think a round of applause for the audience. Seems like we're doing a very good job here. So a round of applause for the others and for the panel as well. So what that indicates is that clearly we've been very concise. We've been very, we are answering all your questions, and as such, you don't have any for us. But I have one more for you, Harry. I know we spent the last couple of minutes talking about battery, because obviously that's where the future growth is. But I also understand that not everyone in this room focuses on the battery market in terms of end product. And I think yesterday, on our way to drinks, I talked to a company, I think it's an Element, they're looking at producing the powders and all that. So for non-battery demand, where do you see the growth over the next 8 years?
So it's easy to not talk about the non-battery applications, even though there's still a fairly significant share of demand. That share will fall, but it doesn't mean the demand itself is falling. We're seeing kind of the non-battery applications probably kind of growing at 2-3% a year over the next 5 to 10 years. There's obviously a lot of individual applications. I won't go into all of them. I guess the major ones really are superalloys and some of the industrial applications. But the superalloy sector's kind of gone through a bit of a turbulent few years, primarily because of the pandemic. But it's certainly come out the other side. And I think the major airline producers, kind of Boeing and Airbus, are kind of moving ahead with their strategy that they had pre-pandemic. They kind of put it on hold, and they obviously had a period where they were having to pull stock out of the system. But that will certainly drive strong demand for superalloys going forwards. At the moment, the metals market is actually probably the brightest part of the overall cobalt market. We're seeing fairly tight supply for medical, for superalloys, for other applications in Europe and the US. So yeah, if you just looked at those metal markets, you'd think that cobalt was looking pretty good. But then I think you have to look at the broader market. But I think it's easy to not talk about them. So it's good to raise it.
Yeah, I don't know if maybe Robert, Yanchen, you have anything to say about the non-battery market?
I think as well, we're looking at probably a similar growth rate over the long term as it becomes like a more minor factor. But I think it's hinging on sort of the macroeconomic view. I guess a lot of that industrial demand sort of got hit significantly in 2020 and having a recovery, but similar to sort of the inflationary issues and the high interest rates, that again is kind of limiting a lot of this industrial action. And so whilst the market might be tight, I'm not sure whether at the moment we've quite seen that return to demand.
Yeah, and any comment?
Yeah, I think from aerospace industry, demand will increase definitely. And the other thing is also from EV industry, but not from battery, from magnetic materials. Cobalt is a very important materials as well. So that is, we can see that is very positive. Yeah.
Yeah, good. So I think we're heading close to the top of the hour. Oh, is there a question? Okay. It's a question there.
Hi there. Tom Fairley, Cobalt Institute. With all this focus on EVs, I didn't ask this question. We talked about subaralloy, so I thought I'd ask the panel about defense uses for cobalt, because that's another area that is non-EV that may have an impact on the market. So any reflections on that before we close up?
I've always spoken to you about this, but it's something that it's very hard to track because, quite fairly, most governments don't talk about their defense spending. But I did have an interesting conversation yesterday with someone saying that I think the metal producers in China are starting to realize that there's quite a lot of material going into the defense sector. And I think that's happening in economies all over the world, given the kind of geopolitical tensions we've seen over the last kind of couple of years in various parts of the world. I think everybody knows that a lot of economies are spending quite a lot of money on defense spending, and that's positive for Cobalt. But the volumes aren't huge. I think it's obviously important, but they're very niche applications, and as a result, they're using fairly small volumes.
Yeah, and I think I can also comment on that. And so one way we track that is really, obviously, we do understand the components that go into the defense, and we do have the intensities that go on a per dollar spend. So that is one of our proxies we use. And if you've looked at the defense scene over the last 2 years, so historically, much of the global defense spend have come from the United States and China. Overnight, we've seen Europe's dynamics changed. So that sort of doubles the global defense spend, and that increasingly translates into demand for defense equipment, which invariably leads to more cobalt demand. So Europe, Australia, and other parts of the world. So we're going to see, on the percentage growth rate, we're going to see significant growth in that space. But I think, like Harry rightly mentioned, in terms of market share, it's still a very niche market, but then equally an important one as well. So yeah, thanks for bringing that up. And any other questions, please? Any other? Yeah, so there's one other area that I wanted to talk about, and it's really about the regionalization of supply chains. And I think a part of my job gives me the privilege to travel around the world. So this year I've been in Australia, I've been in North America, I've been in Southern Africa and Central Africa, and everywhere you go, there's only one sentence that I keep hearing a lot. We want to go downstream. We want to process stuff. We want to produce batteries. We want to produce EVs domestically. And I think ultimately what that is going to lead to is really that regional supply chain, very different from the kind of supply chain we had in the last super cycle with China, where everything was prepared in one melting pot in China and then distributed to the world. So when we take a step back, I think for me, part of my daily job is really to help policymakers measure the expectations of these policymakers that, look, you cannot regionalize or localize supply chains overnight. So it's important to manage that expectation. So I don't know, which in your experience over the last years, how loud is that conversation getting? And what will be, for policymakers and also private companies here, looking to sort of structure their supply chains? Like, what will be your words to them in terms of regional or globalization? And how do we manage expectations if there is a need to? Maybe Harry, I'll start from you.
Yeah, I can start. I think it's been something that I've been thinking about for a few years, and it's obviously gaining quite a lot of pace at the moment, thanks to the kind of the policy announcements in Europe and the US. I think supply chains certainly need to regionalize, and whether that's localized, regionalized. But the fact of the matter is that raw materials and batteries need to be close to the end users, and the major battery markets are obviously China and increasingly North America and the US. So North America and Europe. And we've already seen over the last couple of years a huge amount of announcements for battery capacity in Europe and the US. to reduce reliance on China, but ultimately bring that closer to the end users and the sales of those electric vehicles. Because we talk about ESG, but if you look at cobalt, the material comes out of the DRC, it goes to South Africa, it goes to China, it gets refined, and then it probably goes back to the US, or it goes halfway around the world before you even started. So that, from kind of an emissions point of view, just can't stand for the kind of the long-term sustainability of these markets. So for me, certainly they need to regionalize, and I think the recent policy announcements are kind of heading things in the right direction.
And in terms of costs, because I remember talking to a refiner based in China, and I think he laughed off the idea of regionalization. It's like, look, I'm processing these things 10 times lower the cost of what Europe plans to do. And in the end, I think capital is a very interesting thing, right? Capital will only go to where the returns are higher. I understand the ESG angle, but then obviously there's always that conversation of private capital looking for the highest returns. So once you sort of lay over that capital requirement on top, does it still remain realistic in terms of regionalization?
I think in the short term, probably not, but eventually then there's not going to be a choice. The consumers aren't going to accept it, and the OEMs aren't going to accept it. So it's not a short-term trend, I agree, but it's eventually going to happen, and eventually will build momentum.
Okay. Rob?
Yeah, I think with the IRA, I think it's important to kind of take into account sort of the end market that you're trying to really serve. And on the EV side, I think there was a lot of worry with these OEMs that a lot of their vehicles were going to fall out of that tax credit quite quickly. In terms of the globalization over sort of localization, as much as the US government have been talking about how much need to build out the battery capacity on the sulfate side, they are still making, signing memorandum of understanding with the DRC and with Zambia, looking to help develop their EV supply chain, but also, I imagine, with an eye on securing supply for their own market there. So again, on that cost side of there, I mean, in this low price environment, it doesn't really make sense. Going forward, I think, as Harry said, if they are going to adhere to these rules and try and build out their supply chains, and the price is high enough to kind of incentivize it, and the macro conditions are good enough for consumers to come back to the market, as we expect to see in the EV side, then yeah, I think it does make sense.
Thanks. I don't know if you have any final words on that. Regionalization, globalization?
Yeah, I think every country wants to develop downstream. There's no doubt about that. And from my experience of Indonesia trip, I think that the Indonesian government also want to develop even downstream, not produce MHP only. It's even to go to the battery and the EVs as well. And I think that makes sense because everyone wants to develop improve their economy. And I think currently Indonesia has no royalty on low quality nickel ore, but they consider that, put more on, in the long run, in the future, I think nationalism, definitely will put more limit or measured on the raw material export to the other countries. And so that is quite a challenge for the industry, not only Southeast Asia country, also South American country as well. Yeah, I think that is the one thing we need to notice, pay more attention on that. And the other thing, I think, I agree with the panelists and about the EV battery makers close to the OEM. That makes sense, But the raw materials, the other story, I think.
Yeah. So I think I see my timer flashing, but then I have one final quick fire, one word. We have no minutes. I can see those eyes watching me. So one word. Robert, I'm going to start with you. My birthday is in September. On September 1, what will cobalt prices be?
Lower than what I thought in 2 months.
One word. Done.
I could see it potentially, hopefully, coming back above 15, maybe.
50.
But
50 it is. Hold him accountable if it doesn't. Yanchen, Indonesia is second today, right, for cobalt production. 2025, which country will be second?
Indonesia still.
Indonesia still. Okay, great. Hold him accountable, 2025. And you? I've got one final. Sorry, I put you on the spot twice. People talk about net zero cobalt. Which year do you think we would have our first net zero cobalt?
It's time for coffee, I think.
A round of applause for my audience, please, and then and a round of applause for yourself. Thank you so much, and then it's great.
Thanks, Kwasi. Thanks very much.
Thank you very much. Thank you. Really interesting. Ladies and gentlemen, this is the report that they've been talking a lot about. You can get your copy now at the registration desk and have a look through. As Harry's been saying, there's a lot more detail of everything that he just skimmed the surface on. So, ladies and gentlemen, thank you very much. Thank you.